Everyone, welcome to the session on corporate tax with Premier Brains. This is the fourth seminar in the row which is conducted by us. And in case you have missed previous session, you can always go back to our YouTube channel to access those videos. Today's session is focused on refreshing upon the corporate tax announcements by Ministry of Finance earlier, and also to discuss about the public consultation document issued recently. And given that it's a 1 hour session, we'll go a little bit on complex areas such as taxable persons, free zones treatment, transfer pricing rules, permanent establishment, record keeping, and finally how to prepare for it. But being a 1 hour session, we'll keep it very brief and to the point. So if you have further questions, please get in touch with us later on. Some brief information about Premier Brains. Premier Brains was established about 10 years in Dubai and currently has offices in Abu Dhabi, internationally in Oman and Kuwait. Our business is divided into 4 core elements. First is the audit, which is into external audits, internal audits, due diligence, liquidations, investigations, and forensics. And then we have tax and compliance. We are tax agents, tax consultants, VAT, excise, double taxation avoidance agreement, transfer pricing, ESR, some of our competency areas. And we also work in anti-money laundering law. And the third one is accounts. So we do outsource accounting services and advisory, which is into business valuations, business plans, feasibility study, merger and acquisitions, consulting, and any areas similar to that. Our motto is always to doing the right thing, and our goal is to become an international brand name. Today, we are going to have 2 speakers. First session will be conducted by Bhavna Chopra, who is our tax partner, followed by Hemal, who is our tax manager, and ending with how to plan ahead for the introduction of this law, which will be done by me. Just to give a very brief introduction about myself, I'm a CA and MBA with over 18 years experience. And with certification in AI and machine learning and forensics. My previous experience includes working with Big 4 private equity firm in last 10 years as partner with Premier Brains. Briefly about the other speakers, Bhavna, she's our tax partner. She's an MBA and CA as well with over 17 years experience. Previously worked in tax roles with Ernst & Young, Schlumberger, and with Premier Brains with last nine years. Then we'll have Hemal. Hemal completed his CA way back in 2016 and have UAE experience of over 5 years, of which 5 years is in the tax roles. So with that, I'll not hold on the session more and give it to our first speaker, Bhavna, who will take it up from here. Thank you very much.
Hi, good afternoon, everyone. Thanks, Rishi, for the introduction. So now, I'll be taking forward today's session. So we will, start with a little bit of background about, the corporate tax timeline as to how it started. And then we will go into definitions of taxable persons, then what is the basis of taxation, and about the calculation of taxable income and transfer pricing, tax groups, and various other things. So basically, the corporate tax talks started in UAE on 31st January 22 when the Ministry of Finance made an announcement on the proposed corporate tax regime. So they made a press release and also issued FAQs on their website. And, so that was basically a gist on some of the frequently asked questions and very briefly on how the policy will look like. But there were not much details. However, around end of April, on 28th April, there was a detailed 33 pages public consultation document, which was issued by Ministry of Finance. So the main idea behind that document was, to obtain inputs from the various businesses and other stakeholders like the tax advisors and other interested parties to submit their feedback on the policy regime. and the period given was from 28th April till 20th May 22. So many businesses gave their feedback. So currently it is expected that the law should get issued soon in the either Q3 of 22 or early Q4 of 22. So we just want to mention that whatever provisions which we will discuss in this presentation are based on the public consultation document. So, but this is not the final legislation, because this is not the law. It is only a consultation document, but more or less the law will be in line with the public consultation document. So we can say that, at least 80-85% it should be in line with the PCD document. However, there can be changes when the final law is issued. So as we know, from the previous introduction, which was done in January, that the proposed corporate tax regime in UAE will be applicable for financial years starting on or after 1st June 2023. So, businesses in UAE have around, maybe less than 12 months if they fall into their financial year, or, even 18 months if they fall into the January 24 financial year. So can we go to the next slide, please? So, this presentation which we have prepared are more or less, in line with the sequence which is followed in the public consultation document. So first, we will be discussing about taxable persons. So who will be, taxed in as per the UAE corporate tax? So, so they have covered the definitions of natural persons and legal persons. So natural persons will only be subject to a corporate tax if they are conducting business in UAE and they have a license in UAE. So for example, if a freelancer is conducting business in UAE and they have a license from the relevant economic department or even from a free zone authority, so they will be subject to corporate tax. However, the employment and personal income or any other income like the rental income or the dividend income earned by the natural person will not be subject to corporate tax. Another category of persons is legal persons. So legal persons include any companies incorporated in UAE and those foreign entities which have permanent establishment in UAE. So even the foreign entities which are effectively managed and controlled in UAE would fall into the corporate tax regime. So it has been mentioned that there are certain limited and general partnerships which are not included in the definition of legal persons, and they will be considered as fiscally transparent for corporate tax purposes. When they say fiscally transparent, it means that their income will be taxed in the hands of the partners and not in the hand of that partnership. So they will be considered as fiscally transparent, and the income will flow through and taxed in the hands of the relevant partners or the members of that association or an unincorporated joint venture. Let's move to the next slide, please. So there has been a few categories which have been exempted from the corporate tax. So first is, the federal and emirate governments and their departments. So if the government is acting in their sovereign capacity and not conducting any commercial business, they will be exempt from corporate tax. Wholly government-owned UAE companies which are carrying sovereign activity will be exempt. Businesses engaged in the extraction and exploitation of UAE natural resources which are subject to emirate level taxation will be exempt. Charities will be exempt, and public and private regulated pension funds, retirement pension funds, investment funds will also be exempt from corporate tax. Let's move, please. So another, continuing our topic of taxable persons. So since the corporate tax announcement was made in UAE, so this has been a much more discussed topic about free zones. So as we all know that there are, more than 50 free zones in UAE, and as free zones, they have offered between 15 to 50 years of tax holidays to the free zone persons. So the public consultation document contains a lot of detail on the taxability of the free zone persons. So the default rule is that the free zone persons are within the scope of UAE corporate tax and subject to tax return filing requirements. So when we say within the scope, meaning that either they will be, subject to 0% corporate tax, or they will be subject to 9% corporate tax, which we will discuss in the coming slides as to, which cases they might be subject to 9% corporate tax. So per se, the UAE public consultation document clearly mentions that the corporate tax law will honor the tax incentives which have been offered to the free zone entities, which are the free zone companies or the free zone branches, provided they maintain adequate substance, and also they should comply with the regulatory requirements of their particular free zone. So the definition of substance has not been mentioned in the public consultation document, but we can take an assumption that this could be in line with the economic substance regulations, where they talk about adequate substance to be maintained in the UAE. The free zone person will have an option to make an irrevocable election, and they can elect to be subject to the regular corporate tax rate of 9%. No tax grouping will be allowed for the free zone persons who are subject to 0% tax regime. And also the transfer of losses will not be allowed with the free zone persons. So now in this slide, we will discuss in detail about different transactions and the tax treatment of the different transactions of the free zones. So the basic rule is that if the free zone entities earn income from the businesses located outside UAE, they can benefit from the 0% tax regime. Or if they do trading with the same free zone or any other UAE free zone, they can still benefit from the 0% tax regime. So in terms of earning income from the mainland companies, so there are 3 or 4 exceptions wherein they can still qualify for the 0% tax regime. So which are, first of all, if they earn passive income from mainland. So passive income can be in the form of interest, royalties, dividends, etc. So if it is only passive income from the mainland companies, they can still qualify for the 0% tax rate. Another scenario is that if the free zone company is located in a designated zone for VAT law purposes, and they are selling the goods to a mainland company, and that mainland customer is the importer on the record, then still the free zone income can qualify for the 0% tax rate. Another case would be where free zone company has a branch in the UAE mainland. In that case, the branch mainland sourced income will be subject to 9% corporate tax. However, the free zone entity can still retain the eligibility for 0% tax rate on its other income. So only the mainland sourced income will be taxed at 9%. Other free zone income will be still qualify as 0% tax rate. Another case where the mainland income can still be eligible for 0% tax rate is if the transaction is between the free zone person and its group company in the mainland. So if a free zone company has a group company in the mainland, they can still qualify for the 0% tax rate. However, the payments which are made by the mainland company to the free zone will not be deductible in the hands of the mainland company. So this is one exception where they can qualify for the 0% tax rate, but the payment will not be deductible in the hands of the mainland company. So there is an exception that if the free zone company has any other mainland sourced income other than the exceptions which I mentioned, so this will make them lose the entitlement of the 0% in respect of all of their income. So let's look at more in detail in terms of an example as to understand these different kind of free zone transactions. So let's say there is a company X in a free zone 1 which has a transaction with a company Y in free zone 2. So this is clearly a transaction between the free zone. So this qualifies for 0% tax rate. So let's look at another transaction where the company X has a transaction with company Z, which is outside UAE. So this also again qualifies for 0% because this is with income from businesses outside the UAE. Next transaction is company X, a free zone company having passive income from mainland, again 0%. So if company X has a transaction with company A, which is their group entity in the mainland, again 0%. Another transaction is if the company X is selling goods to company B, who is importer of record on mainland, still qualifies for the 0% tax rate. However, if company X has any other income from company C in mainland, which is a third party, which is not the sale of goods transaction, not a related party transaction, not a passive income transaction, but any other income transaction from a mainland entity, which is a third party, then in that case, this will disqualify the entire income of company X from the 0% regime. And then the entire income of company X, in that case, will be subject to corporate tax. So we can see here, it is very important for the free zone companies to analyze all their transactions, to understand the taxability of their company, because there can be, one transaction which can make the entire free zone income becoming taxable. Let's move, please. So now, let's look into the basis of the taxation. So always, in any corporate tax regime, residency is the key factor to determine if the profits will be subject to tax in UAE. So as it goes globally with all the, tax jurisdictions mostly, that the residents will be taxable on their worldwide income. Who are considered residents? Residents are those legal persons which are incorporated in UAE. Natural persons, if they are engaged in a commercial activity in UAE, like holding a license to do that business activity in UAE. A foreign company will be considered resident if it is managed or controlled in UAE. So if, the directors make the key management decisions in the UAE, they could be considered as, managing the firm, managing the company in UAE, and hence considered resident for corporate tax purposes. So like, the UAE resident persons will be taxable on their worldwide income. However, there are certain exceptions, like for natural persons, that taxable income will only be limited to their business activity carried out, and certain income from overseas will be exempt from corporate tax. For example, any income from the foreign branch. Hemal will be discussing later about the calculation of taxable income, and he will talk about the foreign branch exemption or the credit availability, and income from qualifying shareholdings. For example, what will be the treatment for the dividends income or the capital gain income. earned from foreign subsidiaries. So that will also be, explained by Hemal in the slides which he will take. So, and also if any income is earned from overseas, which is not in an exempt category, but you have paid the income tax in a foreign jurisdiction on such income, then that credit can be taken against the corporate tax in UAE. So there will not be any impact of double taxation per se. So let's move to the taxation basis for non-residents. So non-residents will be considered subject to UAE corporate tax if their taxable income is from a permanent establishment and the income which is sourced in the UAE. So what is a permanent establishment? Permanent establishment concept is taken in the UAE corporate tax regime as per the Article 5 of the OECD Model Tax Convention. So whether a PE will be triggered or not, it will be determined by two main tests. One is the fixed place of business test and other is the dependent agent test. So what is a fixed place of business test? Basically, a fixed place of business is when a foreign company conducts its business through a fixed place in UAE, which could be like a branch or office, factory or workshop, or even a building site where the activities are carried on for over 6 months. So these conditions would qualify for a fixed place of business and could result into a permanent establishment. So fixed place, for example, if it is only a store to display the goods, then it will not be considered as a permanent establishment. There would be more details, included when the legislation is out on the PE conditions. But there are some guidance which is provided in the public consultation document, which mentions like, if the activities which are carried through the fixed days are only preparatory or auxiliary in nature. So for example, if these are only marketing or promotion activities, or if these are only for market research, then those would not qualify as a PE. Another criteria, which is the dependent agent test, is that so if a foreign company does not have a fixed place of business in UAE, however, there are people based in UAE which are acting on behalf of the foreign companies and habitually exercising their authority to conclude contracts on behalf of the foreign company, then such dependent agent would constitute a permanent establishment of that foreign company. And also the public consultation document mentions that these PE rules will also apply to determine if the free zone person has a PE in UAE mainland or not. Let's move further. So what is a UAE sourced income? So like we mentioned that the non-residents would be taxable on their UAE sourced income. So any income which is earned from a UAE resident or a permanent establishment of a foreign company is a UAE sourced income, or any income which is derived from the activities or the contracts performed in UAE, or any assets or rights used for economic purposes in UAE would qualify as a UAE sourced income. So if a foreign company has not created a PE in the UAE, then it will be subject to 0% withholding tax. So it is important to note here is that, when initially the Ministry of Finance had issued the FAQs, they had mentioned that there will be no withholding tax. But however, the public consultation document has made it a 0% withholding tax. So, whenever a percentage is kind of implied in a legislation, then, it leaves the room to change the percentage at a later stage. So we can, say that currently it will be 0%, but, it can be changed later on when the authorities decide to do so. So now the next section will be taken by Hemal on the calculation of the taxable income. So Hemal, please carry on from here. Thank you.
Yeah, thank you, Bhavna. Thank you for taking us through the wonderful insights, like who will be taxed, what will be the impact of CT on the freezones and taxation basis for residents and non-residents. So yeah, now we will go through the like a main concern, like what income will be taxable. So the to make it easy and cost efficient, the public documentation has stated that the calculation of the taxable income will start with the accounting profit. So whatever accounting profit appears in the books, the calculation of taxable income, we can start from that. So now other question arise like how the accounting has to be maintained, because in UAE, companies are following like IFRS, then the some companies properly not maintain the books of account. So law states that to companies has to prepare the financial statements as per the generally accepted accounting standards, which is in UAE, that is IFRS, or companies can also opt for another accounting standards as well, so which can be generally accepted. So once we then after that, like once the income is calculated, there are some adjustment for the tax purpose. So like one of the example is unrealized gain or loss. So public documentation states that there can be a two type of unrealized gain. So one is capital in nature, and the other one is in a revenue nature. For capital in nature, like for example, a company owns a land or building, and as on the balance sheet date, the value of the building goes up or the revaluation has been done, but the building has not been sold. So companies record the unrealized gain in the books, but documentation states that if this is an unrealized gain and it's in a capital nature, so while calculating the taxable income, we should not include in the workings. Also, if it's a revenue nature income or revenue nature gain or loss, that should be like while calculating the income needs to be deducted or added to the taxable income. So we'll move to the next slide, which shows the how the taxable income calculation can be done. So basically, as we mentioned in the last slide, we can start with the financial profit as per the books. So basically, it's a simply we have to take the financial profit which is appearing in the profit and loss. Then companies has to make the adjustments, which is like disallowance adjustments, or the which I mentioned in the previous slide, that can be unrealized gain or loss. Then certain incomes are exempt, which will be see in the next slides. That adjustment also has to be made here. After that, this adjustments, we will get the final taxable income, which on the corporate tax will apply. So currently, up to 375,000 dirhams, the corporate tax rate will be the 0%. So basically, up to that limit, company will not be charged with the corporate tax. So, and after whatever above 375,000, the difference between the 375,000 and the above value will be charged with the 9% corporate tax. So that way the city liability will be decided, which is A plus B, basically 0 plus the 9% value. Then Bhavna has explained in the earlier also that company might be having income from foreign sources and they paid the taxes in the foreign jurisdiction as well. So city public documentation allows the companies to take the credit of that. So here companies can take the credit of that, and the final city payable will be arrived, which needs to be paid to the authorities along with the final like while they are filing the returns. Okay. So as we discussed in the last slide, so there are the certain incomes which are exempt under the corporate tax. So first of all, let's understand what is the logic. So to avoid the double taxation and cement the UAE's business position in the world, they have given this exemption. So first exemption is related to mainly income earned by a UAE company from investment in other companies or operation conducted outside UAE through foreign branch or a foreign subsidiaries. So on these exemptions are available, but we will go through some certain conditions are there. So we can go through this condition in next slides. Then domestic dividends earned by a UAE company, which includes the dividend paid by a free zone person. So the logic behind this exemption is basically a UAE company, which is a subsidiary company, they pays the corporate tax. So to when they declare the dividend on such profit, already tax is paid. So to avoid double taxation, the domestic dividends are exempt from the corporate tax. Then the third one is dividend paid by a foreign companies and capital gains from the sale of shares subject to the conditions. So basically, a UAE company holds the shares in the subsidiaries and they gain the dividend, and also they might get the capital gain on the sale of shares. So these are also exempt from the corporate tax, and we will see the condition which are there for the claiming this exemption. Then also UAE is a major logistics center and the international travel hub. Also, they have a treaties with the different countries for the aircraft and ships. So this is basically for the serve the treaties. This incomes earned by a non-resident from the operation of aircraft and ships has been like granted as a exemptions. Yeah. So as we discussed in the live slides, to get the exemptions, there are certain conditions. So we'll go through these conditions one by one. So domestic dividends. So basically, as we discussed, to avoid the double taxation, this dividends has been exempted in the hands of the holding company. So in case of a foreign dividends, if company receive these foreign dividends and capital gains, this is subject to exemption if the holding company holds more than 5% shareholding of the subsidiary company, or foreign subsidiary is subject to corporate tax at least 8-9%. If suppose they are not subject to tax they are not subject to tax in the foreign jurisdiction, then the exemption cannot be claimed. Also, the third one is capital gains from sale of shares in a free zone person. This will be exempt if the holding company is a free zone company and whatever income they have derived is from the above participation exemptions. So if these conditions are satisfied, only in that case is the whatever income has been generated will be qualified for the exemptions. So let's understand this through example. So suppose a UAE mainland company holds the shares in UAE mainland company, which is 3% only. Shareholding is 3%. So in that case, the dividend will be exempt as the subsidiary company is paying the corporate tax on the total income, but the capital gains will be subject to taxable. Then the another condition, another example is UAE mainland company holds the 3% shares in Indian company, where we assume that the taxable rate is more than 9%. So in that case, dividend will be taxable, and the capital gain on the sale of the such shares also will be taxable. So let's go to a third example where UAE mainland company holds the shares in Bahrain company, when they hold more than 50% share, 5% share, which is 75%. So in this case, also the dividend and capital gain will be taxable, because in Bahrain currently there is no corporate tax, or companies are not liable for 9% tax, which is like no corporate tax, meaning that there is a they are not paying any taxes. So in these cases, the UAE mainland company will be liable for the dividend and capital gain. So, and if those conditions are satisfied, then in such a cases, UAE mainland companies, uh, the income from dividend and capital gain will be exempt. Yes. So as Bhavna also mentioned, like the income generated from a foreign branch that can be considered as exempt. So what are the conditions? So first of all, the foreign branch can claim the UAE company, parent company can claim the tax credit of the payment made by a foreign branch in their foreign jurisdiction, or uh, a parent company can go for the exemption claim from the uh, sorry, yeah. Exemption can be claimed if a foreign branch is subject to sufficient level of taxation in foreign jurisdiction, meaning that if the foreign jurisdictions, the foreign branch is paying the tax which is more than 9%. In this case, the parent company can go for the claiming a request for the exemption from the UAE tax authorities. And if this election of the exemption is made, then this is a irrevocable exemption, and it applies to all the foreign branches. So parent company has to see before applying the exemptions. Okay. Then there are the in VAT also there are the provisions for disallowance of tax credit. In a similar manner, also corporate tax has a certain provisions where they disallow the certain expenses. So basically, first one is interest and other similar financing costs, which is limited up to the 30% of EBITDA within certain exceptions. The logic is basically people can like companies which can go for the higher debt and like claim the more interest to avoid the more taxes. So authority has given the conditions that the 70% will not be allowed. Only 30% of EBITDA can be allowed to claim for the interest and other financing costs. Also, payment made by a mainland company to foreign free zone person who is subject to 0% CT will not be allowed as a deduction. Here, payment basically we assumes that it will be a payment for goods and services, and it will not consider as any other payments, basically like just a reimbursement cases or something. Then the third one is expenditure to entertainment will be allowed to deduct up to 50% only. So here companies may take their clients for the dinner, or like a conference might be arranged. So on this cases, the companies can claim the expenses up to 50% of total expense. Like for example, company has during the whole year, it might have spent 1,000 or 100,000 dirhams for the entertainment. In that case, only 50%, which is 50,000 dirhams, can be claimed, and the rest 50,000 will be disallowed from the calculation of taxable income. Then, as across the world, mostly the administrative penalties like fines or late payment penalties for the return filing, which is generally in nature of the violations. So that will not be allowed as a deduction. Then companies has a recoverable VAT position, which is like they might apply for the refund from the FTA or a tax authorities. So which is lying in the balance sheet asset side of their balance sheet item. So that will also not be allowed as a deduction. But if this expenses cannot be claimed, then in such a case it might be considered as a business expense, and it allowed as a claim. Then certain donations which paid to non-approved organization will not be allowed as a deduction. Then company might have paid a penalty or related party interest that will also allowed if that interest are arm's length prices and there is a valid commercial reason for the loan. So the another interesting provision is basically for the carry forward loss. So the corporate document says that the carry forward loss can be carry forward for the indefinite period, subject to the two conditions, like the if the shareholder remains the shareholder who holds at least 50% of the share capital, which remains the same, or if there is a change in the ownership of more than then in that case 50% of the tax loss can be forwarded, subject to the condition that the same business is carry forwarded by the new owners. So these are the like main two conditions to carry forward the loss for indefinite. So now the next question arises: how much loss company can set off in the particular year? So PDC document says that company can claim 75% of the loss, like 75% of the taxable income in the as a loss, and they have to pay the city on the 25% income. So this we talked about the carry forward of the losses, but there are the question arise which losses company cannot carry forward. So first one is like a loss incurred before the effective date of CT. So for example, a company for whom the CT effective date is 1st January 2024. So in such a scenarios, the losses incurred by the company before 31st December 2023 will not be allowed to carry forward. So that losses is adjusted in the books, and whatever income arise in 2024, company, if it's a profit situation, company can have to pay the corporate tax, and it's a loss, then it can be carry forward. Then another one is loss incurred before a person became a taxpayer. So that's basically before registration, whatever loss is there, they cannot carry forward it. Then losses incurred from the activities of asset which generated income that is exempt. So basically, from the exempt income or whatever loss is generated, companies cannot carry forward it. Losses generated by a foreign free zone person that are not attributable to PE in mainland, because their income is 0%, so they cannot carry forward the losses also. Okay, then I would like Bhavna to take this from the pending slides.
Thank you, Hemal, for the discussion on the calculation of taxable income, carry forward of losses, set off of losses. So now I will, discuss about the provision of tax group. So as we know from like the VAT law as well, that there was an option to form a VAT group. So in the proposed corporate tax regime, there is also an option to form a tax group, which is different from the VAT law provisions. So a tax group can be formed by UAE resident group of companies, and they can be considered as a single taxable person. So the conditions to be met to form a tax group is that there should be 95% direct or indirect ownership. Then free zone companies are exempt companies, cannot be included in a tax group. Also, it has been mentioned in the public consultation document that a signed notice will need to be submitted to the federal tax authorities to form a tax group, and all the group companies must be having same financial year. Let's move to the next slide, please. So the parent company and each of the subsidiary will be jointly and severally liable for the corporate tax liability of the group. As I mentioned, they will be considered as a single taxable person. They will need to form a consolidated set of accounts, and the transactions between the group companies will need to be eliminated to arrive at the taxable income of the entire group. The parent company of the group will be responsible for the administration and the payment of the corporate tax on behalf of the group. Let's move forward. So, in cases where the group companies do not meet that minimum 95% common ownership criteria, or they willingly do not want to form a tax group, there is a provision where, the transfer of tax losses can be allowed from one group company to another group company. Let's move the slide, please. Yeah. So the conditions which need to be fulfilled for the transfer of the losses is that the group companies should be at least 75% commonly owned to qualify for the transfer of loss criteria, and also the maximum tax loss offset is restricted to 75% of the taxable income of the company which is receiving the transferred losses in that period. Move back, please. Yeah, sorry for that. And also, the loss should not be transferred from the companies that are exempt, or even the companies which benefit from the 0% free zone corporate tax regime. So here, I want to mention that, companies need to make a careful decision when making a tax group or not. Is, for example, if you have group companies and all your companies are in a profit situation, then forming a tax group might not result into a tax efficient situation, because in such cases, that exemption of 375,000 will be at the group level. However, if those were individual companies, then individually each company would have got that 375,000 exemption. However, in cases where you have subsidiaries which are, some of the subsidiaries are into losses, which can be offset with the profits of the other group companies, then companies can be in a startup phase and initially they might be having losses. So in such cases of group companies, it would make sense to form a tax group. So a careful analysis need to be done by the UAE businesses when making the decision of forming a tax group or not forming a tax group. Let's move forward. Okay, so starting with our discussion on transfer pricing. So, UAE corporate tax regime will also include transfer pricing regulations, as has been clearly mentioned in the public consultation document. So this is to ensure that, the pricing of the transactions is not influenced by the relationship between the parties. So, and it should follow arm's length principle. So the setting of the prices between associated enterprises should be at on arm's length basis. Currently, the legislation, of course, will include much more details on the transfer pricing methods to be included. But currently, what the guidance mentions is that, this would be in line with the OECD transfer pricing guidelines. And The arm's length principle will also be as per the OECD guidelines. There has been a definition of related parties and connected persons. So there is a difference between related parties and connected persons definitions. So related parties are parties where there is threshold of 50% or more of the shareholding or control, a taxpayer and its branch or permanent establishment would be considered related parties for corporate tax purposes. However, connected persons are, this provision has been introduced because in the UAE corporate tax regime, the employment or the personal income is not taxable. So, the managerial remuneration which is given to the owners or the directors of the company could result into erosion of the corporate tax base of the company. So for such reasons, the provision has been included for the remuneration to the connected persons. So connected persons would include, owners, directors, or even individuals related to the owners or directors up to fourth degree of kinship. So those kind of details are mentioned in the PCD document. So it needs to be ensured that if any payments are made by the company to such connected persons, so they need to ensure proper documentation, and they should be able to demonstrate that such payment or the salary payments which are made to those directors or owners are in line with the market value of the service which is provided by them, and such service is wholly and exclusively for the business of the company. And such kind of disclosures will also need to be included in the corporate tax return, which will be filed by the company, about the information about connected persons and the related parties. So this disclosure on the transfer pricing documentation will be, like an annexure to the return, the disclosure form. And there could also be, requirement for master file and local file requirements to be submitted, depending on if your transactions qualify for the threshold limit, which will be prescribed when the legislation is out. Let's move forward. So what are the compliance aspects of the proposed corporate tax regime? So obviously the businesses need to first of all register with the federal tax authorities within the time limit which will be mentioned in the law. And if they cease to operate the business, if the business is getting liquidated, they will need to deregister them also within the time limits prescribed with the federal tax authority. Then in terms of return filing, annual return will need to be filed with the business. So this has been kept simple right now in the proposed regime. So there will be no advance filing, kind of advance filing requirements. So there will be one annual return which will need to be filed, and that should be filed and tax to be paid within 9 months of the end of the relevant tax period. There would be certain schedules also to be filled along with the return, for which the details will be mentioned in the law. And in terms of, assessment, it will be currently self-based assessment. So you have to self-assess your taxable income, file the return and pay the taxes. In case of any uncertainty, clarification can be obtained from the Federal Tax Authority. And in terms of documentation, if a person is claiming an exemption, they need to keep a record for the exemption claim. And in terms of financial statements, the public consultation document mentions that the requirement of the audit will be as per the company law requirements. So if the UAE company law, asks you to maintain audited financial statements, then the companies will need to do so. However, in the case of free zone persons, if you want to be eligible for 0% corporate tax regime, then you have to mandatorily get your financial statements audited. especially in the case of free zone companies who want to claim the 0% tax regime exemption. So that's it, from our side on the main provisions of the public consultation document. I will hand it over now to Rishi to take you through, the steps which can be taken by the businesses right now to prepare for the corporate tax. Thank you.
Thank you, Bhavna and Hemal, for the wonderful session. I really enjoyed and learned a lot of new things, though I've read it earlier, but still I can see there are certain things which you need to go back again and check. So thank you very much for that. Now coming back to how do we prepare for the corporate tax? So basically, taxes are not new in UAE, as no. So we had VAT in the past, then we had ESR, so things like that. So there is a process and way to kind of approach this in order to have a smooth flow of operation. Because what I've seen from experience is that sometimes, it's taken easy in the beginning, and later when the penalty comes, it becomes a big burden to resolve it. And it's very clear that tax authority do not excuse businesses just saying that they were not aware is good enough an answer. So it's always better to be ready and prepare for it. Just basically what I'm going to talk about another, say, 2 minutes is basically about from the experience, what should be done. So again, this is upon you how you want to approach it and tackle it from there. So basically the first always a good thing to do is to do the impact assessment. So basically what it means in the impact assessment, as you have seen, there are many provisions on the rate of depreciation, the provisions on carry forward of losses, the transfer pricing rules, especially the related party and connected persons, and then things like audit financials. So these are some of the important things which needs to be looked at right now, because if these changes are actually done later on, then the tax authority can always challenge. I'll tell you from experience, when the VAT was implemented, the transitional period was the most important. Till today, there are companies who are sitting on penalties relating to 2018 when the VAT got implemented, because that cutoff date was not taken care of, and it was assumed that nobody will come back to us. So these are important things to look at. Another, forming a tax group is a very, very important decision, because one thing that I've noted is once you form a tax group, you cannot get out of it, which is not the case with VAT. So these are some important things to look at and analyze well in advance. So, this is what we suggest should be done. Then, so this is something which can be done right now, before at the time of public consultation document. Then comes the step of detailed assessment and design. Basically, as you know, the tax law and executive regulation, the official one is not been given out, but which is expected in the third quarter or first, or say the fourth quarter, early fourth quarter. So that is the time to go do a deep dive. And as Bhavna mentioned, that the final law is not going to be very different from the consultative document. The purpose of issuing this document itself is to let companies start thinking about it, get prepared, and then implement the changes as we go close to it, right? And then after the law is published, then an impact assessment in detail is done. Then it comes to the stage of implementation. So June onwards, obviously many companies will follow a calendar year. So there may be the tax year starts from 1st of January 2024. However, many companies will have June starting point. So it's very important to understand when is the ready to implementation stage is reached, because it's not only just clicking a button to get it on, but it's a stage of kind of checking it and seeing if it's really effective, and are we ready really to make those changes, and what's the impact is going to be, how the reporting is done, are our audit financial inclined to what we want to achieve, what kind of tax impact we're going to face on our cash flow. As we know, nobody wants to pay tax, right? So it's very difficult to plan it later on and leaving it for things to happen, but it's always better to plan in advance, especially in the taxes. It always helps a lot based on my experience. So things like, stock record keeping, if the stocks have been kept in proper record and things. Obviously, VAT has changed things a lot, but still there are things to look at, because in VAT we always focused on input output VAT at the end, but when it comes to P&L, the accounting profit, corporate tax come into picture. So a lot of elements which are not a concern in the past become concern now, especially your shareholder expenses, the things which they charge, those kind of areas to be looked at right away. And then once the law is out and obviously it's been applicable to your company, you start operating in a proper way with filing the tax in a timely manner and keeping records in proper shape. So three most important elements, I would say, in any tax implementation involves processes, technology, and the people. And always people is the most important factor. Can you push it to the next slide, please? So I've already covered this point because I was in the flow, so I was just talking about it. So but this sheet is covered. Can you go to the next one? So basically processes, people, and technology are the more important ones. So we are already out of time, so I'm going to stop here. And we'll take another 5 minutes maximum to run through the questions. So if you are not running late, please stay with us. Otherwise, you're free to leave if you like to, because we are in time. So Hemal and Bhavna, can you please join me? And let's look at the questions very quickly and our webinar from. So the first question which is asked is about Aleem, is on the accounting profit. Basically, this question is whether the audited figures is the way to look at it, or you can just look at your management accounts for corporate tax. So what's your say in that?
Yeah, so okay, let me answer this. Basically, during the presentation also Bhavna says that public consultation document mentions that the companies which has to satisfy the requirement of corporate tax companies law. So generally mainland companies are required to do the audit, and most of the free zones also require companies to do the audit. So that can like mostly the companies are compulsorily required to do the audit, so that once the audit is done, that can be taken as a starting point for the calculation of taxable income.
Right. Just to add to just to add my 2 cents to it, like for example, if you look at economic substance regulations or the other compliance law, I mean, obviously it doesn't say anywhere that you need to have the audit financial and all that. However, when claiming an exempt category or other reporting areas, basically audit financial is the starting point. We have done it, I think, number of times. So the best idea for any company is to be on the safe side, to have your accounts audited and follow audit as the accounting profit for your reporting, because ultimately that is going to be the face in front of the authorities before they start digging into your numbers. And obviously a good auditor will always ensure that your taxability point of view is properly been covered. So that's so doing an audit is always better in my opinion. Okay, the next question is free zone company dealing with mainland company and delivery of goods within the free zone area. Then is this sales comes under taxation?
So yeah, basically there is a provision if the who is importer on record. So here free zone, just like I have concerns with the free zone, they are meaning that this designated zone or something, because from the VAT perspective, it's a designated zone, and the importer on record is the person of the mainland company. In that case, free zone company can it's they are not required to calculate it will fall under zero rated. But if it's a importer on record free zone company, then they might disqualify for the corporate tax regime, from the exemption or zero rated category, and they have to pay the 9% rate tax on all the income.
Right. Just to add one more point to it, if you look at Article 3.33 of the consultative document, it says that any mainland source income will disqualify a free zone from 0% CAT regime in respect of all their income. So what it means to say is when you're at that stage of deciding between income of a mainland of a free zone, please be 100% sure. I would say 200% sure, because if it is taken wrongly, it can disqualify the entire free zone from 0% CT. So this is an important point to mention, and Hemal already mentioned about the important on record. So that should be looked at. So next question is, any disallowance on provision of expenses, any special disallowance for insurance sector, like disallowance of unexpired risk reserve. So this is the question, disallowance of expenses. Bhavna, you there? Or Himal, please, if you have a.
Sure. So basically, this is a industry-specific question, and currently, like this public consultation documentation, it's not clearly defined regarding the insurance sector how the unexpired risk or reserves will be dealt. But if your disallowance on provision expense, so it's as per the requirement of IFRS, the provisions are made. So in such a case, this will be allowed as a deduction.
Right. And also, the consultative document, I'm sure you might have read it and already discussed during the session about the interest rate capping. And another thing which I have noted was that the expenses which a free zone is charging to mainland, which is coming under 0% CT, so that might not be claimable for the mainland company. And secondly, there will be a cap on the entertainment, I think for the shareholder and all this, there's a reference of 50% on that. And the other one will be penalties and donation to unapproved charities. These are disallowances. However, more details will be in the detailed law, but it is giving a feeling of what's going to happen. Any TP methods prescribed?
So currently there is no TP method prescribed, but that will more guidance will become with the legislations, and it is like in line with the OECD guidelines on the transfer pricing.
Yeah, that's correct. Okay, the next question is, in threshold for registration, if income is below 375 AD, is registration necessary?
Yeah, so basically, if it's a mainland company and there is a taxable income, so they might have to go for the registration, because there is a 0% rate up to 375,000 dirham. And so there is, like, what we understand is there is no limit if they are having a taxable income.
So you mean it's the profit, right?
Yeah, it's a profit. So because also the free zones also has to go for the registration, even though their profit is taxable at 0 rate.
Okay. The next question is from Alim again. Financial year from March 23 to Feb 24, taxable will be for the full year, only for the July onwards. So I think, Alim, in this case, your financial year will start from 24. There is no, I think, discussion on partial charging for the tax.
Yes, so that will start from March 24 to Feb 2025, and that return will be filed in 2025.
All right, I think people are saying thank you, and I thank you very much for being with us, learning with us. We'll share the video later on with you, and feel free to write to us directly so we can handle and answer your questions as we go. Thank you. Bye-bye.